All right, we're picking up where we left off in the previous recording. I'm looking again at problem 1-9A, and the first part of this problem, we were presented with a list of transactions for Sony Electric. It was started by Sanyu Sony, who started it with a cash infusion of $65,000, in which, in exchange for that, they got $65,000 in common stock, and then they proceeded to begin operating the business throughout the month of December. And so we recorded all the individual transactions, which of course I did in the previous recording. Now, if you notice at the bottom of the spreadsheet that I created, we have balances across the bottom, and what you'll find is these, of course, are going to tie to the financial statements. And so, if you recall, we started out this business really without any cash at all. So our initial entry was to put cash into the business. So we started off with a balance of 0 in cash, and we ended the period with a balance of $59,180 in cash. And all of these transactions that occurred during the period are either going to be classified as operating, investing, or financing. And that's where we're going to get our statement of cash flows from. The numbers across the bottom here, well, this is where the balance sheet and the income statement and the statement of retained earnings are going to come from. So what we'll have here is we have the assets portion of our balance sheet, we have the liabilities portion of our balance sheet, and then we have the equity portion. And retained earnings is just the difference between revenue and expenses. And what will happen is, over time, the revenues and expenses, we close out net income to retained earnings every fiscal period. And so retained earnings will change from year to year depending on the amount of net income or net loss that is paid out. And equity will change based on that and the amount of dividends and any investment in the company that occurs. And so we calculated our net income. The next part of this problem, what they wanted us to do is then, okay, now go ahead and create the financial statements. And so I've already done that. I formatted them. So here is our income statement. Very simple. It's a single-step income statement. Notice the header. I formatted it, Sony Electric income statement, and month ending December 31st, 2020. Again, month ending is important because it gives the a sense that this is a period statement. It's not a static statement. And so we have our sales revenue for the period, the expenses for the period, and our net income. And of course, that ties back to the main worksheet here. Okay, so you should see the congruence there. Now, what's going to happen is the statement of retained earnings, net income, is going to increase retained earnings. So we create a statement of retained earnings, which is a shorthand version of the statement of shareholders or stockholders' equity. And so the statement of retained earnings, notice again the heading. We have company name, the name of the statement, and month ending December 31st, 2020, because again, it is a period statement. It summarizes the changes that occur in this particular part of equity over the period of time. So we began on December 1st with 0 in retained earnings. By the end of December, we had net income of $4,160, so that increased retained earnings. We paid out dividends of $950, which is going to decrease retained earnings, and so we now have an ending balance of retained earnings of $3,210. And that would be consistent with the difference here. Okay? And so when we take the net of dividends and revenues and expenses, we end up with that amount that's showing here in the ending balance of retained earnings at December 31st. This piece of information becomes very important because then what we're able to do is build the balance sheet. Again, now there's a couple of options here with the balance sheet. The first option here is a vertical presentation. And on the vertical presentation, we list assets. We show our current assets and our non-current assets. And we show subtotals for each. So we have our cash, accounts receivable, and office supplies. So we have our total current assets. And we have non-current assets, electrical equipment, and office equipment, and what our total non-current assets happen to be. and then we come up with a total. If we've done everything right, which we checked here in the ledger, because remember, I had this column over here, and this was telling us that all of our entries were in balance, so we should be in balance on our balance sheet. And so we have our liabilities, accounts payable, and then the total current liabilities. In this version of the problem, there are no long-term liabilities, so that is our total liabilities. And then we have our common stock account, the retained earnings that comes from the statement of retained earnings, and then we have our total equity. We add up total equity and total liabilities, and we come up with $76,760, which matches our total assets, so we're in balance. The other presentation you can have is called a horizontal presentation, and I believe they show you this in the book, and this is the side-by-side. The advantage here is that you're immediately drawn to this line here, boom, and so you can see you're in balance. And this is more like the scale. They use the vertical presentation here often in annual reports because it fits neater on a page, an 8.5 by 11 sheet of paper, which is usually about the size of a page in the annual report. This presentation here often stretches across 2 pages, and that makes it a more difficult presentation to read. But from a spreadsheet standpoint, I think this presentation is easier on the eyes to pick out what you're looking at, because it pits assets against liabilities and equity, which is the way this really works. Okay? But it's the same information, just presented. This is pulled over to the side, and you have a horizontal presentation. And I always try to make sure that my total assets line and my total liabilities and equity line up along the same, because that's nice and neat for the vision. Remember, we prepare these things so people are going to read them. So we want to give them a vision, we want to give them a presentation, we want to format them so that they're easy on the eyes to pick out the information that they want. Now, the statement of cash flows. Now, here's our statement of cash flows. And so we have our cash flows from operating activities, we have our cash flows from investing activities, and our cash flows from, that's supposed to be financing activities. So I'm going to change that right now. That's the other nice thing about doing this. And that's what we got. Okay, cool. So we're good now. All right. So how did I figure this out? Well, this is where you have to go back to the ledger and the individual transactions. So the focus here is on the cash column and what's happened in the cash column. Now remember, the business was capitalized with $65,000 in cash. Well, that is considered a financing activity. So if we go back to the statement of cash flows, notice the cash received from investors, $65,000. Okay, so we know that that's going to be a financing activity. As we go down the line, you're going to identify each transaction that occurred and what type of transaction. So if it's a sale to a customer for cash, or if it's a collection on a receivable from a customer, that's going to be cash received from a customer. That's an operating activity. If it's cash paid out to a vendor or supplier, it's some form of expense over here, okay? Then it's going to show up as an operating activity. So what we have is we have cash received from customers at $6,200 and cash paid out as expenses for $3,740. And basically where that comes from is going through each of the transactions and figuring out, okay, what exactly is going on here? How much cash is actually left the company, okay? And so some of that can be gone through. So I'm going to run through the transactions that we originally had. So we have the $65,000 in cash that was paid in. That's a financing activity. We had the payment for the office rent expense of $1,000. That is an operating activity. We had cash. The company purchased $13,000 of electrical equipment by paying $4,800 cash and agreeing to pay $8,200 balance in 30 days. Because this is impacting the equipment portion of their business, this here is going to end up being a investing cash flow. So that $4,800 in cash that's paid out is investing. The company's purchase of office supplies for cash, $800 cash, that is an operating activity. The company completed electrical work and they collected $1,200 in cash. That is cash received from a customer. That is going to be an operating activity. Again, the next transaction where they purchase additional office equipment on credit, that's not going to show up in the statement of cash flows until they actually settle that liability. The company completed electrical work and they extended credit to their customer. That won't show up in the statement of cash flows until they actually collect the $5,000 in cash. The company purchased $350 of office supplies on credit. Again, the same thing. That creates a payable. It doesn't impact cash right away, so it's not going to show up on the statement of cash flows. The company paid $2,530 cash for the office equipment purchased on December 8th. That additional office equipment at the time was purchased on credit, so it did not impact cash. The payment of the payable, that will impact cash. And again, that particular transaction is going to show up in the investing portion of the cash flow statement. The company billed the client $900 for electrical work. No cash involved there, so it's not going to impact the cash flow statement. The company received $5,000 cash for work completed on December 15th. That's a receipt of cash from a customer. That is going to be an operating activity. That cash is going to be recorded. And then the company paid the assistant's salary of $1,400 cash for this month. That's an operating activity. The company paid $540 cash for this month's utility bill. That is an operating activity. And the company paid $950 cash in dividends to the owner. That is a financing activity. So the two key financing activities that occurred were the first transaction and the last transaction. The $65,000 in cash that was put into the business, and then the $950 paid out to the owner as a dividend. The operating activities all had to do with either payment to employees or to suppliers that supplied current assets to the company. So things like your office supplies. The other items that show up as cash outflows are the payables that were paid back to folks that you bought equipment from. So when we go back to our statement of cash flows, that's what we see showing up here. So the cash paid for the electrical equipment, $4,800, shows up in the investing activities section. The cash paid for the office equipment shows up under the investing activities. The $6,200 you can trace back to the ledger by looking for those payments. So remember, this is the $4,800 for the electrical equipment. That shows up under investing. This $1,200 in cash was cash that we received for services provided. So that's going to go under operating activities. We also have the $5,000 that we received from customers. And so that's where the $6,200 comes from cash received from customers. In terms of the cash paid out to suppliers, that's going to show up. We had the office supplies purchased for $800. Okay. Then we also had the, let's see, we had the $1,400 for the salaries of the assistant. We had the $540 paid out for the utility bill. Those are all going to show up as operating activity disbursements. And so in the end, what you should end up with is you should end up with this amount of cash here of $59,180. Okay? And so that ties to, if we go to the balance sheet, that ties to the balance sheet, $59,180. So at a minimum, we know that we at least got all the cash transactions recorded properly. In the end, the mistakes that you could make would be how you classified them as either operating, investing, or financing. And again, the only way to do that is to go basically line by line through each transaction and classify it as whether it was investing, financing, or operating. And that's the way you would have to handle it. And so a lot of times what I do is I just kind of run down and the page and on these problems, and I just have 3 columns, and I put the amounts, and I list those amounts that are positive, those amounts that are negative under either the excuse me, operating, investing, or financing column. And so again, I'll run through this real quick again. The $6,200 was made up of the $1,200 that was received from one customer and the $5,000 that was received from another customer. The $3,740, that's made up of $1,000 paid for rent. It's made up of $800 paid for office supplies. It includes an additional $1,400 that's paid out to the assistant for salary, and the $540 that's paid for the utility bill. And that should total up to $3,740. Okay, and then down in the financing, I told you the first transaction, the cash infusion, that was a financing activity, and then the payout of dividends was a financing activity. And so that's a simple way of putting together the statement of cash flows. And this actually would be an example of the direct method of preparing the statement of cash flows. And in a simple problem, it's not so hard to figure out. There is an indirect way to calculate the statement of cash flows. That's going to be the method we're going to learn in a chapter that will be upcoming. So the last part of this problem, they wanted you to do a little bit of analysis here. And so the last item is item number 4, requirement number 4. It says, assume the owner investment transaction on December 1st was $49,000 in cash instead of $65,000, and that Sony Electric obtained another $16,000 in cash by borrowing it from a bank. Compute the dollar effect of this change on the month-end amounts for assets, liabilities, and equity. So for total assets, total liabilities, and total equity, they want to know what the impact of that change in financing arrangement is. So we went from putting in $65,000 in cash to only putting in $49,000 in cash, and the rest of it, the $16,000, would have come in the form of a bank loan or a bank note. And so how would that impact the bottom line? Well, they still received $65,000 in cash, so the cash account remains unaffected. Okay, so since that cash account remains unaffected, this transaction, the change in the facts of this transaction, does not affect the asset side of the balance sheet. So that means the effect is limited to the liabilities and equity side. So originally we recorded $65,000 of common stock because it was the owner that invested the $65,000 into the business. Now, instead of using equity, they have used a combination of equity and debt to open up this business. And so what you would find is you now, instead of just having the current liabilities of accounts payable, you now have a long-term liability, a note or loan payable to the bank for $16,000, and you only have $49,000 in the common stock account. And so what I've done here is I went and I recreated the balance sheet showing the impact here. And so again, there's no effect on the asset side of the equation. That's exactly the same as it was up here under the original set of conditions. What's changed is the liability section. Here we only had current liabilities of $85.50, and we had common stock of $65 and retained earnings of $32.10. Of course, retained earnings isn't changed. What's changed is common stock here. Common stock is now $49,000, which equals the amount of cash that was put in by the owner, and we now have a long-term liability, a loan payable of $16,000. The bottom line doesn't change. Okay, total assets still equals total liabilities and total equity. What's changed is the balance between equity and liabilities. Okay, and at some point soon we will learn how these kinds of decisions about how a business obtains its capital can impact financial measures, ratios, calculations that folks use to kind of evaluate how well a business is doing. So hopefully this helps you guys out a little bit. We've worked through a pretty extensive problem here that covers a lot of concepts in the chapter. One thing I want to make sure that you understand, oftentimes I hear from students, well, I never saw a problem like that before. They didn't teach us that in the chapter, and you didn't teach us that in class. What we are teaching you and what the book is trying to teach you is concepts. And it's in the application of those concepts that you will struggle. And that is where everybody struggles when they learn accounting, because there are many different ways that we can pose a question to you. But you have to understand, and what you have to see through, is that it all comes down to application of the same basic concepts. We are testing you on the accounting relationships that exist. It's just the nature of the questions can come at you in different ways. Okay? So don't let the question fool you and think, oh, this is something brand new. I've never seen this before. Yes, you may not have seen that exact question before, but you've seen the concept. You need to focus on the question that's being asked within the problem, because therein lies where the concept is going to come out. And then you'll be able to recognize, I know this, because I know the accounting equation. I know what is under each of the elements. Remember, if you know your accounts, if you can tie your accounts back to the elements, assets, liabilities, and equity. The accounts are things like cash, accounts receivable, the equipment, the supplies. If you can tie those to the elements, and you can keep them straight in your head in terms of their classification as to whether they're current or non-current on the asset side, or current and long-term on the liability side. If you understand the calculation of retained earnings, which is just merely the accumulated net income or net loss of the business over time, and we will talk about the closing process that actually closes the income statement. Again, our net income here of $41.60 closes out to retained earnings. We see that right here. So here's our statement of retained earnings. Here's where net income comes into retained earnings. The dividends reduce the retained earnings. The retained earnings ties to the balance sheet. So we can go to the retained earnings on the balance sheet. And so you can see how the interrelationships, how each statement is connected to one another. With the statement of cash flows, right? This explains where cash came from and where it went. And how does it tie? It ties to the balance sheet and the cash balance. Okay? So again, this is not going to come easy to everyone. It's going to take some work. And again, you're going to have to learn to dissect some of these problems. And I will provide some examples within the next week or so of how I usually try to break down the problems and get to the heart of the question. But that is what you're going to have to do. You're going to have to recognize that we're focusing on the concepts. Don't let the question trick you. Okay? All right. Well, I'm going to sign out for now. Hopefully this will help some of you guys out.